All right, so it's 4 o'clock. Welcome, everybody. We're glad that you're joining us for today's webinar. My name is Greg Patterson, and I'm joined with my colleagues, J.A. Canady and Tara Gould. And we thank you again for making time to tune into our market update webinar. We've got a lot to talk about, so let's get started. J.A., let's look at the overall view for today. So we'll take a look at what we'll discuss. Obviously, we want to talk about current market returns and bring you up to speed on that. That is kind of the elephant in the room. We'll also hit the recession indicators dashboard and take a look at the conference board's leading economic indicators. Both of these will provide some perspective on where we think we are as it relates to recession. And we'll also speak about a current economic update, looking at just this last quarter. We're going to talk about energy, labor, wages, yields, and inflation. I know those things are on everybody's minds. We'll also share some valuable perspective on equity markets and give you an update there, both as we look in the rearview mirror, but also where we think we're going. And of course, with this year being a midterm election year, you guys have seen the signs out at the voting places. And so we'll talk about some perspective around that, as well as volatility in the markets, and then give you our conclusion and our thoughts, some actionable steps you can take today and what you should be doing as it relates to money management. So a quick housekeeping item. At our last webinar in March, Spectrum, our internet was cut off by Spectrum. So it was just a short, brief outage. We did come back on. And for those of you who stayed on the webinar, you joined back up, or we joined back up with you rather. So we'd ask you to do the same this time as well. If something out of our control happens, we'll come back in just as soon as we can. So stay tight, stay put, and we'll be back with you. All right, so let's take a look at the elephant in the room. The S&P 500 today looks like it'll close actually somewhere around 4,000, which is down over 16% year to date. The actual high for the year was January 3rd at 47.96. And so quite a drop from the first of the year. Everything was felt really good going into year end. We had record economic growth, and of course markets were responding to that growth. And then January hit, and of course, you may have remembered the Omicron fears and the impact of that with the record number of COVID cases. Of course, we've had supply chain disruptions along with a short labor market. I think there's 2 jobs for every person hiring or every person needed, or every person actually applying. We've had Fed fears with rate rises, inflation. We've had Russia and Ukraine, which was not on the dashboard in January. So just a record number of things taking place over the last several months, which has caused this selling stampede to take place. And it's not just been in the S&P. The NASDAQ is actually off over 20%, and the Dow's down about 10 for the first part of the year. But let's share a little bit of perspective, because these times are not unusual, nor are they abnormal. They do happen. You can't set your watch by them, but they are fairly frequent. So let's take a look back just over the last 5 years, and you can see that same index, which is the S&P 500. It's 100% stocks. So it's not indicative of many of your portfolios if you are a client. If you're a prospective client, we thank you for tuning in, and you would realize that as well. But 100% stocks here. You can see the big drawdown in 2020. That's March, when COVID first showed up on the scene. But you've had other times over the past 5 years where it has pulled back. This time it just feels different, and that's what we're hearing from our clients. And we hope to share some perspective around why we think it's not actually that much different. But it is unexpected at this point in time because we've had such a good run up over the last couple of years. So with that, we'll take a look at overall U.S. recession indicators. J.A., you want to help us out with that?
Be glad to. Good afternoon, everybody. Thank you for joining on the webinar with us this afternoon. And And we wanted to start here because it has been some time since we've heard the big R word batted around, but we have had that recession term enter into the conversation here of late with the inversion of the yield curve, the Fed's tightening policies and raising rates, energy prices spiking, and then just inflation in general. And one thing we always do is just to look at the data. And one of those sources for data that we look at is this risk indicator dashboard. It's put out by ClearBridge Investments, but it looks at 12 variables that historically have foreshadowed a looming recession. And so just beginning with the end in mind, if you drop down here to the bottom, this is showing over the last 3 months. You can see things have, for the most part, remained the same with some slight changes over the last month. But the overall signal here as of the end of April is a green upward arrow, which signals continued expansion in the economy. I'll drill down into these, some of these in a little more detail. But basically, we've got, as of the end of April, there's 8 of these indicators or variables that are pointing to expansion. 3 are yellow and 1 is red, which is a negative indicator. I'll start there with the negative X or the red X on wage growth. And so we have actually wage growth has been positive this year, and especially on a historical basis. But when you compare that with the rate of inflation, it has not kept up. Wage growth specifically has not kept up with inflation, hence the red X there. We've had two of these yellow indicators that just turned yellow over the last month. In tracking this on a monthly basis, these two, it's not unexpected that these would turn over to yellow. We've looked at them as being kind of in between green and yellow for a little bit of time here now. But with the recent volatility in the financial markets, it has caused commodities and this credit spread variable to turn yellow from green. On the commodity side, we don't look at that as having a very high ranking across these 12. The credit spread one would be, have a little more significance than the commodities. But we're more overall encouraged by the labor market indicators across these 12. Up here at the top, jobless claims and job sentiment. So we've had encouraging numbers from jobless claims, but this job sentiment measurement, it really measures the labor differential. So what's the number of people saying that jobs are plentiful versus the number of people saying that it's hard to get a job. And so that measurement of job sentiment is the highest it's ever been, pointing to a positive variable for the economy. We've also seen tremendous job growth over the last few months on a historical basis. So we had the April numbers come in last week at 428,000 new jobs, and we were in that same range for March and a little bit more the month prior. So we have seen job growth, and we're encouraged by that because we really have not seen the economy go into recession with the labor market this strong. So that's kind of just hitting on the recession risk indicator dashboard, this one specifically. We also like to take a look at it from a historical perspective. And this chart kind of shows, looking back over times when we have had recession or we've led into recession, what has this dashboard looked like? And so you can see here, going back to 1969 and 70, everything is either red or yellow. 73, 75, similar with just a couple green arrows. These other points of recession, 81, 82, 80, 90, 91. But when we compare that to how we are today or at the end of April, it doesn't look the same, right? 2020 was a little bit of an anomaly because we put the brakes on immediately with coronavirus entering into the picture. So I think these other years prior to that, recessionary times would be more of a comparison than the 2020. But it does give you some perspective, and we think that this provides some encouragement too around where we are and where we're headed. One of our other data points that we look at is put out by the Conference Board, and it's a leading economic index of 10 different leading economic indicators. There's some overlap between the recession risk indicator dashboard and this LEI, leading economic index. But we like to look at both of them to try and determine where we're headed. And so if you focus on the right-hand portion of this chart, which takes us, this small gray line is 2020 when we went into recession briefly, but coming out of there, we've had this leading economic index continue to be positive. And then even from a historical basis, looking back over the last 62 years, this chart kind of points to the overall trend in this LEI index. And you can see the gray bars are periods of recession. So we've had 9 periods of recession over the last 62 years. And you can see how the leading index tends to turn over and provide some indication beforehand, hence the term leading index. But on a historical trend basis, we are very much in line with just continuing expansion in the economy as we looked at with the other dashboard. I'm going to pass it on to Tara to talk about some more specifics here.
Great, thank you very much. We have a lot going on here. I'm going to try and break it down. So what we see here is what we're doing is we're overlapping the recession indicators, which JA talked about, with oil price spikes. And the first thing I want to start with is just by saying that historically, every recession has been preceded by an oil price spike. Now, while that's true, there is a difference between that correlation and the cause or causation. And so historically, recessions have come after oil price spikes, but that doesn't mean every time we have an oil price spike that we're going to enter into a recession. And so what this chart is going to show is going back into the 70s, and it's just highlighting when there's been a 60% spike in the price of oil. And you can see that many times that does come in a cluster. What I want to highlight is that when we are in a frail economic state, and what that means is those recession indicators, we had a lot of red and we had a lot of yellow. When that occurs in those instances, that didn't turn into a recession. However, when we have a strong economic background, historically 5 out of 6 times that we had these oil spikes, the result was non-recessionary. The one time that it was recessionary, and you can see on the chart, is in 1999. And specific to that time frame, we had 3 oil spikes or price spikes within about an 8-month period. And during that time, we entered a recession, but not until 21 months later. So there was a gap in time. The key takeaway here is that historically, when we have a few economic indicators that are at yellow or red, which we are as of today, that still has pointed towards economic expansion and not recession.
And Tara, it's also noteworthy the S&P return 12 months after. I think
Absolutely.
There's 3 instances at that bottom line where stocks were negative 12 months after over those 10 recessionary time periods. But the other times, markets were positive and had recovered by then.
Good point.
JA, anything you wanted to add?
I think that you guys cover it.
That's good. Okay. You want to go to the next slide. And so JA alluded to this before, and you were correct on the number the second time. It was 400 and 68,000 new jobs in April that U.S. employers reported. And our unemployment rate right now is at 3.6%, which is very low. What we expected to see, and we've had this conversation in the office quite a bit, is back in September when stimulus payments ceased, we had that pullback. What we were expecting to see was for laborers to enter the market. And when that didn't happen, we were sitting there thinking, okay, what exactly is going on? What we now know is that the consumers were living off of their savings. But what we see now is those savings are depleted and they are now beginning to re-enter the labor market. On the right-hand side, on the chart that you see, this talks about the participation rate. And you're going to see the prime age that we're talking about here is working age, which is age 25 to 54. And so pre-pandemic, we're at 83%. And now you can see we have crossed 82%. That's a very good sign. What happens when people are working? People have jobs, they have money to spend. And when consumers are spending, that keeps our economy moving forward.
Another draw, I think, that has brought people back into the labor market has just been increased wages, right? Some folks
Sure.
have seen the opportunity that's presented itself that may not have otherwise taken advantage of that, but or jump back into the market, but are taking advantage of the opportunity to increase wages.
Yeah, and that's a great segue for our next slide. And the question is, can consumers continue to spend with inflation and price increase? And so first, I just want to explain this particular chart. And the colors are a little bit difficult to see, but I'm going to start with the bottom. And the bottom is just CPI or rate of inflation. It recently ticked up to a little over 8%. But this is that inflationary measure. And what you're going to see at the blue line is 10%, which is the aggregate weekly payrolls. And so what we see here, this graph just explains that year over year, take-home pay or compensation growth has now risen to the point that it is higher than inflation. And so this chart shows the wage growth plus an increase in the hours worked by laborers. And so what this just tells us or indicates to us is that even with the higher level of inflation, prices being higher, because the compensation has increased, consumer spending should continue.
We also are optimistic too about the number of jobs that are open. I think the stat that I read was over 11 million jobs are currently open. So that's
right.
That's also positive.
Absolutely.
Yeah, and this, not to be confused, I talked about the wage growth and how there has been wage growth, but it hasn't kept up with inflation. This is looking at, as Tara said, overall net pay, basically overall payrolls, which incorporates increased in hours as well. You really don't see this stat reported on, but it's important to take a look at in terms of the strength of the consumer, which ultimately drives 70+% of the economy.
All right, so what you're looking at in front of you is the actual chart of the 10-year Treasury bond yield. And we just crossed over 3% on the yield. This is the interest from the 10-year Treasury. And that 10-year Treasury is used as a proxy for mortgage rates, probably auto loans and other financial instruments that charge interest. And historically, the mortgage rate, or at least over the last several years, was under 5%. I think we were talking in the office the other day about a 2.25 30-year fixed mortgage. Well, this 10-year Treasury in front of you is showing that that's no longer the case. So we were talking with a client of ours, and the 30-year mortgage now is in the mid to higher fives. So that's going to cause borrowing costs to go up, of course, and make it more expensive. Also to note, when yields go up, when you see a chart like this that's rising to the right, the price of the treasury bond is going down. So, or corporate bonds or any type of bonds are pegged to that. And that's what we've experienced thus far year to date. Both bond prices and stock prices have declined in tandem, which is not, it's not supposed to do that, but that has been the case thus far. The Fed controls this activity, but also supply and demand does in the bond market. And so it's a signal of how the bond market views inflation and growth. And right now we see that it's not looking too kindly on that because we are in an inflationary environment. So this has been the highest level since November 2018 amid concerns of this surging inflation pressure and potential slowing economic growth. So there's many issues for this beyond just inflation, of course. I mentioned supply and demand, but also Russia, Ukraine, and that situation, the current lockdowns in China, that's been a case most recently that's caused this to rise. And so it is somewhat concerning and caused us to reevaluate the bond positions in our clients' portfolios back in March. So as this started to rise and pick up steam, we did make some adjustments to portfolios to better position for that rising rate and help clients protect and preserve principal. The next chart is just taking a look at analyst consensus around inflation. And what you're looking at left to right is that both on the left side is PCE inflation and the right side is CPI inflation. These are just two indicators of an inflation measure. They're the most common in the US today. The CPI is the Consumer Price Index. It's released by the Bureau of Labor Statistics. And the PCE is a Personal Consumption Expenditure Price Index, and it's released by the Bureau of Economic Analysis. So the important part here is to take a look at 2022 in both charts. And while they don't always move in tandem, they tend to. But look at the further you go out to the right, you can see this big spike in prices. And there's a headline and a core. The headline measure and a core measure, the core strips out the more volatile food and energy components. But if you're like us, you still have to purchase gas and food. And that's probably where you've seen it the most at the gas pump and in the grocery store. But you've also seen it if you were building a home, the price of your building materials has gone up and so forth. But you can also see the dotted line. That's the expectation that with the Fed raising interest rates, that's the tool that they have at their disposal to slow down and cause inflation to decrease. Many economists expect, in this case, this graph was put together by Goldman Sachs. Many believe that inflation would actually start to come down later in the year and certainly through next year. I think that's been one of the concerns on everybody's mind is, are we stepping back into 1980? There was a recession in 81, but if you think about what happened back during that time, the Fed did step in, raise rates, and it caused prices to drop. And it happened pretty quickly during that time period. And as Will Rogers says, history often repeats itself and sometimes it even rhymes. So here we are expecting that to decline later in the year. And the next is just taking a look at the historical trend for GDP or gross domestic product here in the US. And what you're looking at, the top line, the top dotted line there is best growth in 37 years. And then that, I believe that's purple below it, is the best growth in 17 years, excluding 2021. And what you're looking at in those gray bars is just the US real GDP actual results from 1984 through 2021. And then the far right of that chart is showing, I guess, a teal color of expected slowing earnings, but still positive. And so following the collapse in COVID, which you see that negative in 2020, we had the best growth we've seen in 37 years come out of that. Yes, there was government stimulus, which helped, but there was also pent-up demand, and we believe that's still the case today. We think the economy, in spite of some of the challenges, is still fairly healthy. Just coming out of earnings season, we're seeing corporate earnings meet or exceed their expectations. And we do know that inflation has a strong headwind to overall growth, but we are expecting the second quarter GDP to be positive, as well as the third quarter GDP. And we would expect somewhere around that 2% mark for the full year, annualized for 2022. So again, I know there's a lot of concerns out there with overall growth, especially since we just had the first quarter at a negative 1.4, when most economists felt like it should be a positive 1. I think our understanding of that, a lot of it was due to the trade imbalance, and some of that being shipped outside the US, but we are seeing some improvements to that as well. And part of the supply chain, I believe, is being resolved by opportunities created right here in the US. So overall, our thought is that it's a slowing growth, but we're not nearing recession at this point in time. Jay, this kind of dovetails with your overall comments on the recession dashboard and the leading economic index.
Mm-hmm. Yep. And so we also wanted to transition in light of those comments about the economy. We wanted to also take a look at the market, and kind of the theme that we've had up to this point is that it doesn't look like we're headed into recession. So in light of that, we do view this recent volatility and that we've seen in the market as a pullback versus a market crash. And we kind of define market crash as a period of downturn in the S&P 500 of 20+% for more than a year, or for at least a year. And we've got information about that on the left here, versus a pullback being a downturn of 15% irrespective of time. But you can see here, there's periods of market crash that we pointed out about 6 here. All but one have led to recession. And the average number of days has been 557 days versus, from a pullback standpoint, 136 days. And the returns, this is a measurement. If you took a snapshot before the market turned over and started heading in a negative direction, what was the S&P index at that point? And then when it bottomed out, adding 12 months to that. So this negative 16% return would be a year after bottoming out, as compared to when the markets first started going down, versus with these pullbacks that we've noted, on average, you've had a positive return of 8%, looking a year out from the market bottoming out. And again, just that goes back to, so for example, if we said, the high in this recent pullback, if the high was the end of the year, right around it, January 3rd, I think you said, Greg, if we were to bottom out next week, for example, we'd add 12 months to that. And then the comparison of 12 months from that time period to January 3rd, on average, we've been positive 8% during those market pullback time periods. But to contrast the crashes versus the pullbacks, crashes have tended to be much longer. So over 4 times longer, much more severe, with 42% declines as opposed to on average 20%, and much more likely to coincide with recession. I did want to just highlight some of these. There's 1, 2, 3, 4, 5, 6, 7, 8 times we've looking at here from a pullback standpoint. The amount of decline in the S&P ranges here, and from 34% was in 2020 with coronavirus, 19, 16, 20, 17. So we're kind of in that range now. We're approaching it currently based on the numbers today that we looked at the beginning of the presentation. Many of you may remember the fourth quarter of 2018 when the S&P was down almost 20%, 19%. But again, if we looked out 12 months, so the end of 2019, we were up 10% over where we had started, before that drawdown or pullback. So I think it's important for us to keep these things in perspective. And again, going back to our analysis on economic risk factors and recession indicators, these pullbacks, more likely than not, do not lead to recession, as opposed to these market crashes where they all 83% of the time right here have led to recession. So hopefully that provides you some perspective and encouragement around where we are. We also wanted to take a look at sector performance and again provide some perspective. This is Greg's favorite slide. He wanted to go over this one with you guys, but it didn't work out. He's let me do it. So you can chime in if you'd like to, Greg. But basically, this is just taking a look at sector performance. You see the sectors on the left, and there's large companies measured by the S&P 500, mid-sized companies and small companies. But there's 2 columns for each. In the black, these percentages are the returns over the 2-year period from the end of 2019 to the end of 2021, this past year. So that incorporates coronavirus and the volatility around that. The blue numbers are just year-to-date numbers. They are measured as of the end of April. So there would be some adjustment to these if we were to take a snapshot today, maybe a little more negative. But the point here, if you look at, let's just focus on large companies with the S&P 500, the index return over the 2-year period from end of 2019 to the end of 2021 was 52%. Year to date, I guess we looked at down 16% now, was our estimate as of 1:43 p.m. this afternoon, right, something like that. So when you expand the perspective, if you've been invested, you're still in a good spot when you consider, being invested from the end of 2019 till today. And just zeroing in on some of these specific sectors, I mean, information technology, we could probably take this 18.7% number is probably in excess of 20% now, but over the previous 2 years, we were up 93% in that specific sector. And it's the case in most of these, with the anomaly or the outlier being energy, which we've talked about already on this presentation, but energy has been the sector that stood out in a positive direction for year to date. It's easy to focus on, how much am I down year to date or over the last month or over the last 2 months. But, hopefully this does show that when you extend the perspective, and it is important to expand the perspective to look at if I've been invested over a period of time. Volatility is to be expected. We know the market's going to be down about 2 out of 10 years, and we're not promising clients that your account values are not going to be down during those 2 out of 10 years. We are trying to mitigate risk around that, but we know that long-term money that we can keep invested then you're able to benefit from long-term returns and outpace inflation over time.
Okay, so I'm going to let you absorb this a little bit while I explain it. But what I'm hoping to do here is just to normalize, maybe that's not the best word, but normalize these intra-year corrections. And so what this chart is going to show, we're going to go back to, in this case, the 80s, the early 80s. And the average intra-year market decline, or wouldn't necessarily categorize it as correction each time, but intra-year decline is at 9.9%. And so what that means is overall, over the course of the years, we expect the market to decline. But with that being said, also across those years, even though we saw those market declines intra-year, we had an average rate of return, and this is annualized, at 15.9%, even in spite of these declines. And so hopefully that provides some historical perspective that these are to be expected. Market corrections are to be expected.
And it's noteworthy that there was 6 negative years out of, since 1983 as well, but an intra-year decline in every single year.
Absolutely.
So to keep perspective around, I heard someone on the radio say that investing in the market is like going to Vegas. It's actually not. The odds are much more in your favor that you would have a successful outcome. And of course, this is just 100% stock. So
correct. And I think the title to the slide says everything. We're going to expect volatility, but that doesn't equate to a loss in your portfolio unless you sell. And so the next one is just another historical perspective. What this shows is that in years in which we have had midterm elections, which is this year, the markets have been volatile. I like the word that we use here, which was choppy. And so in this particular chart, we're going back to the 60s, so a very broad range, a very good historical perspective. And so you can see that in the years in which we had midterm elections, that there was market volatility or market decline. And across this time frame, the average correction during these years was at 19%. But what I want to highlight is, while that's painful, we take a look at the recovery. And the recovery is, what is the market performance 1 year after these corrections occurred? And the average recovery during this time frame was at 32%.
That's noteworthy.
Absolutely. I think it just, again, helps to kind of normalize what's going on.
So Greg and Tara and Mackenzie, we all kind of chuckled at this slide here, but I think there's some truth in it that is applicable to what we do as well. So this headline, as a result of all that's gone on over the last couple of years in the country, not just with coronavirus, but this example just happens to be related to it. The headline there says, "Our ability to assess risk has been impaired." And they're in a study of 400 bicyclists at Stanford University. 46% were wearing a mask, but only 17% were wearing a helmet. So this idea of risk assessment, and fear is a very motivating emotion. We've seen, I think, it kind of impact our society as a whole more and more recently, especially. But it can also cause us sometimes to misplace risk or misassess things. And just like this example here with choosing to wear a mask over wearing a helmet, the risk assessment on that is, you know, a head injury
Yeah. Little
versus
words.
riding in, yeah, exactly. So that brings me to this next slide, which you know, assessing the risk, it's painful, right, to see account values going down, and there's this tendency out of fear really to want to stop the pain and sell out when the market gets volatile. But there can be tremendous cost to that and risk associated with it, and just the impact of of impacting in a negative way your long-term plan. And so you could see here, each line is a decade return of the S&P 500, just from a price return standpoint. And this first column here is the price return over the time periods. And the second column is if you took out the 10 best trading days. So we're only talking about 10 days out of
10
a
years.
decade
Right.
that we're removing. And you can see the difference in returns here. So if we look at the 2010 decade, price return of 190%, but it drops in half if you take out just the 10 best trading days, which interestingly enough tend to come very close to the worst days in the market.
Mm.
Market tends to overreact and then compensate. So in this 2020 line example here, you can see 33% price return, taking out the 10 best days, negative 24%. So it could be the difference between positive and negative returns. So I think it's important to assess risks from a long-term perspective as opposed to a short-term. And that brings me to maybe the most important slide that we're going over today. We do here look at just the Word of God and the Spirit of God for truth and peace and comfort. And so this verse here, we did utilize it in our last webinar, but we thought it was appropriate to just read it again, go over it again. This is from Philippians 4, verse 6 through 7. And Paul is writing, do not be anxious about anything, but in everything by prayer and supplication with thanksgiving, let your requests be made known to God, and the peace of God, which surpasses all understanding, will guard your hearts and your minds in Christ Jesus. So we've been given this promise of peace and leaning on our Heavenly Father, who is over all. He's over all that's going on in the market, all that's going on in the world. And he's given us his Holy Spirit and his word for us to lean on. So we encourage you to do that. We try to do that ourselves here.
Thank you for that, JA. And we're just going to wrap it up. It seems like the fastest 45 minutes ever. We hope you've gotten something out of this. A lot of it is perspective, and we hope that by expanding your time frame and sharing the perspective with you, that it would help you have a different outlook than being caught up right in the middle of what's going on. Our conclusions on the U.S. economic outlook, simply put, we believe the recession risks are well below average, and we've shown you why we've come to that conclusion based on several key indicators that many leading economists use. Our preferred version of the yield curve, that 10-year over the 3-month has steepened, recently indicating continued economic expansion. And rather than use the 2-year and the 10-year, we use the 3-month because it's had less false positives as it looks at trying to predict the next recession. So we don't think that's going to happen this year, possibly pushed out to 2024 at the nearest based on that indicator. Next, the economy should continue to strengthen post-Omicron, partially negating the impact from higher energy prices. And so, many of us have gone on with our normal lives, and that has continued to, I think, enhance the demand aspect of our purchases and being out in the economy, traveling. Many of you as our clients and prospective clients, we've heard from you and you've gone back to traveling, whereas you did not a year or so ago. So we believe that's going to have some very positive outcomes in the economy. And then lastly, on the economic outlook, consumer headwinds are less than consumer tailwinds. So inflation is certainly a headwind, but we believe that the consumption numbers, retail sales, new home permits, all these things that stack up form a strong tailwind. And, we believe that's going to continue on for a positive outcome for the U.S. And would show up in later GDP earnings as well as corporate earnings coming out. As far as the U.S. market outlook, these markets have often experienced choppiness as the economy and accommodative policy transition from early to mid-cycle. We believe we are moving into a mid to later cycle. And so it's not unusual, as I said before, for markets to pull back. Last year, we did not see any major days in the market that were sell-offs of over 1% strung together. It was actually a very good year in spite of some of those headwinds. So the choppiness is not unexpected. Current headwinds include tightening monetary policy. So again, the Federal Reserve raising interest rates to tap the brake on inflation. We see midterm elections as another choppiness and a headwind. Negative fiscal impulse, geopolitics such as Russia and Ukraine, and the issues there, and higher inflation. And in our view, any sell-off would be a good opportunity to reposition for the middle innings of the market cycle. It's also a good opportunity to add money if you've accumulated cash that's just sitting at basically 0%, as long as it matches your overall goals and your objectives. So on the right-hand side, that recession dashboard signal is positive. It's green and expansionary. We continue to update this on a 30-day lag. So we're looking in the rearview mirror, but only by 30 days. And so that's where we come up with these conclusions. As you know, if you're a client, we follow some very tried and true principles with investing your hard-earned dollars. We want to first make sure you've got cash that's set aside for a reserve for any short-term upcoming expenses that are known, and also those that are unknown. So we usually ask you this in our meetings, and we try to help you think about things that would be coming up. And we also think about things that you might not know about. And so our recommendations there are to keep cash in a reserve. And this is not money that would be susceptible to a market decline, but it would be available for you if you needed immediate liquidity. So we still hold true to that regardless of what's taking place in the stock market. And then on that front, we would always tell you to match up the longer term portion of your savings and investments with a portfolio that's designed and customized to your objectives. If you need income, making sure that it's got dividend paying equities in there. It's the only asset besides real estate that would help you overcome inflation over time. And that's proven to be the case. Bonds won't do it, cash won't do it. It has to be equity. So we want to review that and make sure that you're still comfortable with the level of risk. And again, we think part of our value add is to sit in front of you and have those conversations to make sure that you're still on track to meet your goals. And then I think a very important part of this is doing some in-depth planning, knowing your situation, knowing you beyond just a balance sheet, but knowing you as a person, what's important to you, why you're saving, and then making sure that those plans that we put in place still make sense. And then lastly, just to provide some peace and perspective on this, these time periods that we go through are part of a natural investment cycle. They do happen. Again, you can't set your watch by it, but it does happen where markets do go down, and that's normal. It is not unusual. My grandfather passed away when he was 95, but he bought stocks in a day and time where they would mail the certificate to your mailbox. And he would put it in his safe or wherever he kept them. But he didn't get a statement. He didn't have online access. He only knew what his value was as if he did the math when he looked at the Wall Street Journal. And he knew the reason he was buying those equities was to get income to help him supplement his pension and his Social Security. I would say today we have day-to-day access. You can see the values daily. Many of you guys on this call might even look at your accounts online with us multiple times a day, and the value doesn't change. So, we know that's taking place. We would just encourage you with your short-term money, pull up your checking account, your savings account, and look at that on a regular basis. But your longer-term investments, just be patient. These time cycles happen, and we will get through it. Lastly, I want to just share a note from our firm to you that with the days ahead, we are not guaranteed anything. And of course, that goes to our investments, it goes to our savings, et cetera. But what you can do is know that we can put our faith and trust in Christ. And, that I think makes a big difference, and not to be swayed to and from by the daily press headlines. We are looking at this on a regular basis, all of us here at Atlantic Wealth, and we take the opportunity to share this with you seriously. We also think of it as an honor to serve you and your family in this way. And so we appreciate that. And we do take that honor and privilege seriously too. If you have any questions or any concerns with anything you've seen today, just email us. You can do that at Greg, Greg, at myatlanticwealth.com. And we'll be glad to answer any questions that you might have and offer any more perspective if you need it. Also, if there's anything we can be doing for you, if you're a prospective client and you're on this webinar, please reach out to us. Again, that email is Greg, Greg, at myatlanticwealth.com. We'll be glad to follow back up with you. You can always call us too, 252-515-7800. We're glad to speak with you at our first opportunity. So we thank you for being tuned in, and we hope this has been helpful for you and your situation. And we just wish you the best afternoon today. See you guys.
Have a good one.